This is Eric Mwatha with Mwatha.com. It is a market analysis for the week of March 26, 2012. We see that on the week of March 19th to the March 23rd, the market saw the Dow giving up about 150 points. So it was a down week, but pretty much not much has changed in the market. And let's take a look at, especially if you take a look at the Dow Jones from a daily chart. This being a Dow daily chart, it's very obvious that the market is trying to find support. If you take the intraday lows of going back to all the way to the beginning of October at about 10,400 and draw a straight line connecting it to the lows of about in December 2011, you draw a straight line, you'll see that the market has bounced off this line twice in March, beginning of March, and then again here recently, just bouncing off that line. So unless the market can break below that line, then there's no need to really start expecting the market to go down, because it's finding support where it needs to find support. And that being the case, you just have to assume that the market wants to move higher given that bounce on this very obvious line on the daily. If you take a look at this from a hourly chart, a Dow Jones 60-minute hourly chart, and you'll see again intraday 60-minute chart, hourly chart shows that the market finding support where it needs to find support. Most recently, this bounce here over the last couple of hours, markets finding support and bouncing off that line. So this is a market that continues to be on an uptrend, very obvious uptrend, and you play that uptrend until the market sometime in the future breaks this trend and trades below this level. Then maybe we can start seeing a push to the downside. For now, markets finding support where it needs to find support, very textbook. So really there's no point in fighting what you see. This bounce in the market is pretty much locked in for now until the market maybe breaks that trend line, but for now still looking very strong. If you take a look at the ERY, which is 3 times energy bear ETF, what I wanted to point out here is if you take a look at this dotted lines here, these lines that are vertical lines that are drawn here, corresponding with a high here, and then this line here corresponding with another high here in the stock, and this red line here, a red arrow corresponding with that high. Now this is important because this levels here, this area here which was a high, this level here which is a high, and this level here corresponds to very obvious levels on the RSI, which I'm going to show you here shortly. And it is quite obvious that if you draw a straight line, you see that that corresponds with this RSI turn point there, RSI turn point on that level, and RSI turn point there. That line corresponds with the most recent action in the stock. So which means that ERY, which is a bear ETF, has peaked, and the price range here also shows that this could also be a short-term high. That being the case, you have to understand that every time this instrument peaks, the market goes into a rally mode, because this instrument is inverse the stock market. So just looking at this one chart here, there is confirmation or indication that the stock market is going to continue moving higher in small chunks here and there, given that this instrument is showing us there is a sell point right here. So this inverse bear ETF is showing us a sell signal, which means the market is going to continue pushing higher. Now I think gold is back in play, because if you take a look at DZZ, which is twice bear or twice inverse gold, you'll notice that its price channel highs have now been hit, which is this recent consolidation area here. This area here is an area of resistance now, and I think eventually we are seeing this instrument push is going to be pushing lower. Also, if you take a look at the RSI, you'll notice that the last time this instrument had a double top on the RSI, which is there, corresponds with the high this instrument made late June, early July of 2011, and we saw gold push to as this instrument went to fresh 52-week lows fresh all-time lows, we saw gold move to a fresh 52-week high, a fresh all-time high. So we are seeing a double top again here on the RSI, which might suggest that this area here is an area where this instrument is now going to see prices reflecting lower prices. That might suggest this instrument moves lower and we see gold rally back, at least have an uptrend starting around now. If you take a look at the gold, if you take a look at the GDP, DGP, twice gold ETF, you'll notice that on a weekly basis we have this line that has been holding gold in an uptrend. This line is where this instrument is finding support this week, so which means it's about 1625 was a low in the intraday low this week for the gold index, which is where this instrument just stopped here. So we see, in other words, we are finding support on this line, which has held gold intact going back to about for about 2 years now. So this still remains an area where gold is bouncing, and like I said, the DZZ, which is inverse gold, is showing a sell signal, which means gold is back in play. Again, if you take a look at this, might be also corresponding to what I suspect here is a head and shoulders for bearish head and shoulders formation on UUP, which is two times gold. Is it two times or once? But anyway, UUP, which tracks the gold chart, is I think it's 1-for-1 gold ETF. You see that this is a left shoulder, head, right shoulder, suggesting that again I think the dollar pulls back and gold comes back in play for a short, at least in the short term. Now, some of the reasons why we really have to be vigilant here, because the market, some areas of the market are showing us sell signals. For example, if you take a look at the Dow Transports, you'll notice that Dow Transports have not been able to move above this level here on the weekly chart. Dow Transports are finding it difficult to move above those price channel highs. Also, Dow Transports finding it difficult, in fact giving a sell signal here, because if you take a look at this RSI highs on the weekly, you see that we have formed a double top here on the transports weekly RSI. That to me suggests early signs of a sell signal, and so maybe again we are seeing that the Dow Transports might be leading this market lower. If you take a look at the, again, let's bring back the chart for the Dow weekly chart, and we see that this area here, somewhere here, this corresponds to RSI breakdown here in April. Let me show that. So this, so that I can show that differently here. You see that this RSI, there was a sell signal here which corresponds to the highs, last year's highs, about April, May of 2011, corresponds with the RSI break. We are seeing the same RSI formation given this current market turnaround. You'll see that on the RSI, the same two areas are noted here as being this area here where the market made a high last year, and we see the same RSI resistance level on the weekly chart. Again, what that tells me that the RSI might be predicting that sentiment has peaked out, and the next week to week direction in the market is going to be lower. Again, if you take a look at the IYR, some other troubling signs in the market is we are making incremental price highs on the IYR, but yet we see that the RSI is not corresponding. We see a negative divergence as the RSI makes a lower low. So that divergence can spell trouble for our market. Again, you also see it on the MACD with this lower low on the technical. So again, some troubling signs in some sectors. Take a look again at the Russell 2000, and what I wanted to point out here is again the same scenario as the Dow Transports. We can't seem to move above this and stay and close above this level here. So that seems to be an area of resistance. Again, the RSI on the Russell 2000, showing resistance. Again, you take a look at the highs, you see that we've been unable to stay above that level. This might be again some other troubling sign in this market. Let's take a look at the JP Morgan here. Again, I was taking a look at JP Morgan, and what I noticed is that, you know, over the last 3-4 years, the JP Morgan on a weekly chart has been unable to stay above this level here. Let me show that differently. Let me see if I can. You'll see that JP Morgan has been finding it very difficult to stay above that level there, and now we see JP Morgan trading exactly at that level, actually hitting that high intra-week and pulling back. Also happens to be an area where you have this back test of this line that connects to the lows, price lows of 2009, March 2009. So we see that this here was a break point, which was led to the sell-off middle of last year, and so we are back testing this level here. So we have resistance coming from this price range here on the top line, and also back test of this line. So somewhere around here we are going to see JP Morgan having some trouble moving higher, which might suggest to me that after this nice run in the market, especially in the financials, that soon we are going to see them pull back after a nice run. Let's take a look at JP Morgan from a monthly perspective. Now this is a chart going back 2003 monthly chart, and we see that we've been unable on a monthly basis, going back all the way 2007. JP Morgan has not been able to close on a monthly basis above this level, and we are currently trading exactly at that point. So this again, after a nice run over the last couple of months, after a nice run from $30 all the way to 45, almost in straight fashion, I think the next move is for a pullback, which is going to be normal. So expect a pullback in this market. Now if we take a look at some world markets, you'll notice that we have the same negative divergence. Let's take a look at 3 markets here. Let's begin with Brazil. The Bovespa, you see it's been making daily highs here over the last couple of weeks and months. Daily highs on price improvement, making new highs, but yet we see that the technicals have been declining, and this might be the reason why we see this pullback, because as the market was making new highs on the price, technical picture kept making lower and lower highs, and hence this pullback, quite frankly, here back to the 50-day moving average. So then again we also see a break of this RSI trend line here. So there is some weakness developing abroad, especially in the markets I'm sharing here. Let's take a look again at the French market, the French CAC 40, and you'll notice that it too was making incremental daily highs over the last couple of weeks, but we see that the technical picture never really improved, as the RSI was showing that it actually never made any new highs. So again, technical picture not as good. So that usually tends to be a recipe for down markets down the road. Again, take a look at the German DAX. Again, same scenario, you know, over the last couple of since February, making incremental highs in price, but the technical picture was not following through. As you see that the price is negative divergence, again, no new highs on technical picture. Again, that usually tends to be a reason for markets to go down, especially if they cannot hold, let's say, trend lines. If, for example, if this market can't hold this trend line support, if it breaks below this level here, that's going to be again indication that the negative divergence was giving us a sell signal in the market. Sometimes it's hard to know until down the road you see the breaking down of trend lines. So I'm going to leave you here. We are celebrating our 10 years in the business, so you know, wishing you continued good luck over the next 10. Let's see how the markets behave, but you know, I think net you have to play quality breakouts in the leadership sectors in the market. Otherwise, be on the lookout for a pullback at any point. This is Eric Muather with Muather.com. Good luck, peace, and blessings.